Hi, good morning, everyone. Hope all of you are good today. For today, restaurant service management, I plan to go into the new chapter, which is chapter 7, finance and accounting. And in this chapter, we will be learning a few important concepts in finance and accounting. I guess many of you, or maybe all of you, have gone through the principles of management. I'm sorry, principles of accounting class. And what we are going to discuss today is not the new things to most of you. So, without wasting any more time, I will start the chapter. So let us go very quickly about the accounting principle that you as the restaurant owner must possess, the accounting principle that you must understand in order to run the restaurant operation. Number one, as a good restaurant owner, you must know how revenue is generated. It means how many sources of revenue stream or how many sources of revenue that you will get in your operation. Um, Firstly, it will be from the food sales. That is very obvious for any restaurant. Secondly, is the beverage sales. Now we are talking about the other stream of revenue, which may be including your catering services and also retail services, because some restaurants also they are doing catering, they call it outside catering services and also retail services in the restaurant. So all of these are considered as stream of revenue or sources of revenue. So as a good restaurant owner, you should be aware of all the revenue stream in your restaurant. Number two is how costs are incurred. How costs are incurred refers to how many types of costs that you actually deal with. And in any restaurants, it can be understood that you will have the two major types of costs. Number one is fixed costs, in which the cost will not be affected by the volume, I mean the sales volume. And also the second one is the variable cost, in which they are the costs that are directly related to the sales volume. Variable cost means it will get higher when the sales is high, and it will get lower when the sales is low. That is variable cost. I will discuss in details what are the example later. Next, you should know the ratios such as check average. Check average means how much is the average amount spent by the customer. It means that average spending of customer. Sometimes you have a lot of customers in your restaurant, but the amount or the share of average amount among the customers are very small, and it will lead to not really good sales for the restaurant. So you might want to know what is the average check or average spending of your customers. If the average spending is higher, means you are likely to have more sales. Next is seat turnover. Seat turnover simply means how many times your seat is replaced. Turnover means replace. Guys, the more the time one seat is replaced with customers, means you have more customers in your restaurant. More likely, when you have more customers, you will have more sales. And last one is the quick ratio. Quick ratio is the ratio in which you will evaluate the liquidity of your asset, how much assets can be turned into liquid to pay all the debts and commitments. Sometimes we have all the fixed asset that we cannot change into liquid. Liquid means cash. it is very dangerous if we don't have enough quick asset. Quick asset means asset that can be turned into cash very fast, because when you don't have cash, you cannot pay salary, you cannot pay loans, you cannot pay debts, you cannot pay your utilities, you cannot purchase goods. So it is important that you have enough cash and enough quick asset. Remember, quick asset is the assets that can be turned into cash very quickly. For example, is your inventory. Inventory means stocks in your store. When you sell the stocks, it can be changed into cash. Next is we will be learning about break-even points. Break-even points is the point in which the dollar amount that you should make in order for you to not be at loss in business. You should not be at loss at business to survive in business. So break-even point is actually the minimum number of sales that you generate to cover all costs so that you will not be at loss. And next is developing and analyzing profit and loss statement. Next is your ability as the restaurant owner to actually study the profit and loss statement. You should be able to read the profit and loss statement, and you should know the proportion, how it should be, what is the highest possible percentage of certain category in the profit and loss statement. We will discuss very detailed afterwards. And also you should understand how to read the balance sheet. Balance sheet is actually the statement in which you want to see the balance between your asset and your liabilities with your owner's equity. So if assets is equal liabilities plus owner's equity, means you are safe, you have enough asset to pay all your loans and debts. Guys, let us go into details of all this. Number one, you should know that in it the two accepted methods of accounting is accrual and cash basis. However, accrual method of accounting is considered the best for food service operation, because this accrual method accounts for sales and expenses as they incurred. Guys, what does it mean, accrual method? Accrual method is in which you will record sales and costs when you are incurring them. For example, I give you one example. Guys, when you purchase your stocks, you will not put the purchase cost as your today's cost. If you buy the asset, sorry, when you buy the stocks and you put in the store, it become your asset, not your cost. When you use in the kitchen to produce sales, and then it become cost of sale, which is cost of operation. When you put in the store, after you have purchased the food and you put in the store, we consider this as your current asset, which is stocks. So the proper way of recording cost and sales is using accrual method. Accrual means it is accrued, not really when you exchange the cash. Can you see here? Not when the cash changes hands. When you pay to the supplier, it doesn't mean that you have incurred the cost. You only incur the cost when you use in the kitchen. That is how we record the cost and sales in restaurant. We use the accrual method of accounting. Next is accounting period. This one is one general knowledge that you as the restaurant manager should know. So the general or accepted and most popular method of recording the accounts is you use the accounting period starting from January 1st, and you end the records of accounting on December 31st of the same year. So this is the largest option used by many food service operators, so that you will start the new year with the new accounting book. And it is more, I guess this is more logical method, and it is more appropriate method of recording the accounting transactions. And record keeping, it is actually you should keep track all the sales and costs in the book so that you can compare actual sales and also incurred costs against your projected sales and costs. So you will compare well when you have the proper record. Guys, I see you in the second video.